Okay, everyone, let's take a look. I'm going to show you 4 reasons why I think that the market is overvalued. Now, it does not mean that the market is going to drop. It just means that the market is really overvalued the stocks for the reason that I'm going to show you. But it also means that it is at the mercy of a black swan. It's at the mercy of something not going right. It's at the mercy for a reason to dump those stocks. Okay? Because usually when that happens, when you go afterward and you say, hey, why did you do this? Why did you sell stock? Well, it was overvalued. Okay? So let's take a look at the first one. Now look at this chart. This shows you the S&P. This shows you the S&P price versus earning growth. Now look at this very carefully, okay? As you could see, the look at the blue line, marginal corporate earnings growth, right? And we are going back to sometime around, early March 2023 as a basis. Look what has happened to the price inflation. It's getting wider and wider and wider. So the expectations are building up to a point that we are pretty wide. So that's overvalued. It seems to be dropping, right, recently, but we're still very wide. So with that kind of wideness, kind of the width, you got to wonder, is this too much? Okay. Now, at the end of the day, what you have to realize is the earnings are going to go up because we're going to be releasing earnings every quarter, so that the fourth quarter is coming up. As the earnings are going to go up, hopefully the stock price doesn't move too much and we kind of catch up, but still there's a lot to catch up here, people. So we are overvalued. So watch out. The second chart that I want to show you has to do with the U.S. versus global ex-U.S. equities. Now, that one is a doozy because it goes back from 1950 to 2022, and you could see that the U.S. versus the global equity is even higher than the internet bubble when we compare ourselves to globally. Now, granted, these guys are having a lot of issues right now, but still, we are way above where we should be. So be careful there as well. Here is the excess cap yield versus the S&P 500 subsequent annual return. And from a tactical standpoint, markets are teetering on the edge of a correction. Why? Well, the exuberance has been a destructive factor for some time. And as the chart below illustrates, what valuation reaches extreme, as you could see when you look at the annualized excess return, demonstrate that performance tends to decline significantly in the following years. Look what happened, when the white line, look, see the white line? The white line goes up in 2021, and then 1941, and then 1991. It tends to be a problem for you. US and European equity returns were much more similar before 2009. Look at the chart on the left. You see how close they're tied together? And look on the right. On the right, we are really, really, really way above the S&P versus the Euro 50. We're getting way too fast. And then, of course, the final one. This is what is called the most critical macro development unfolding today. And what this means is that even when adjusted for inflation, the 30-year yield has recently reached its highest level in 15 years. The U.S. cannot sustain this for too long. It will need either higher inflation or suppression of the rate to alleviate the pressure. I mean, rates are a problem. What does this all mean? It means that we are at the cusp of something. we're at the cusp. There's a lot of pumped up expectation on the market, which is good, but there's a lot of pumped up risk. Think of it this way. On one end, we are extremely overvalued. On the other end, you've got Trump running around saying he's going to do a bunch of things that may or may not be inflationary. You also have, Trump doing things that are going to be helpful for everyone. You also Trump that wants to potentially invade some countries the way he speaks. The other day, Trump is also going to be helping not having Third World War, according to him. So it's like that, right? So the market does not like this. Overall, it feels positive, but I'm telling you, folks, we're at the mercy of a bad surprise. Either he signs the tariffs, that's going to be bad. Either we start to worry about the debt, and that's going to be bad. Or we have something that we haven't thought of, and that you have to worry about.